Two guys, same age, 27, same city, same income, both pulling around $58,000 a year. Both opened a brokerage account for the first time in the same week, March of 2009, each with $5,000 they'd scraped together. Both had read the same personal finance article about investing in your 20s. Both were terrified. The market had just collapsed 57%. The news was wall-to-wall disaster. Unemployment was climbing toward 10%. CNBC had started running the word crisis in red letters so often it might as well have been their logo. Guy number one looked at all of that, said, "This feels completely insane," and moved everything to cash. He'd wait for it to stabilize. Guy number two gritted his teeth, kept investing his regular $500 a month, and doubled down when things got worse. By 2020, guy number one had roughly $18,000. Guy number two had over $210,000. Oh, and one of them had a roommate with an inexplicable collection of medieval swords. Turned out to be completely irrelevant. Same starting point, 11 years apart in outcome, and the only difference between them was what they decided to do during a 3-month window when the world felt like it was ending. Right now, we are in that window again. The headlines are screaming catastrophe. The data says something completely different. And most people are about to make the exact same mistake guy number one made. My name is Nick, and I have spent the last 3 weeks building spreadsheets about 2009 stock prices while my friends were doing normal human things like going outside. If you've ever felt like you keep doing the right things with money but somehow never actually get ahead, subscribe. Because what I'm going to show you today might be the most important financial context you'll have for the next decade. Not an opinion, math. So let's start with what's going on. Because if you've turned on the news lately, you've probably felt that specific kind of financial dread where you're simultaneously panicking and not entirely sure what you're panicking about. Here's the situation. On February 28th, the US and Israel launched strikes on Iran. By early March, the Strait of Hormuz, a 21-mile wide channel that carries 20% of the world's daily oil supply, was effectively shut down. Oil was at $72 a barrel before the war. By end of March, Brent crude had hit $118. That's a 63% spike in a single month. Biggest monthly move since 1988. The market did what it always does with uncertainty. It freaked out. S&P 500's worst quarter since 2022, down 4.6%. The Nasdaq dropped over 10% from its highs. Microsoft is down more than 20% year to date. Tesla over 21%. The VIX, Wall Street's fear gauge, nearly doubled, spiking from the mid-teens to over 35. The CNN Fear and Greed Index, sitting around 8 to 17. Extreme fear. Readings this low have appeared on just 3.4% of all trading days since 2011. 3.4%. What the financial media is telling you to do with all of this? Panic. Watch the next segment. Maybe buy gold. Watch another segment about whether you should have bought more gold. Here's what 100 years of actual data tells you. That's what this video is about. Before we get to the opportunity, I need to explain why this feels so scary, because understanding the fear is how you stop being controlled by it. Think about a family commuting 40 minutes each way, nothing left at the end of the month before the war even started. Gas is already up 35%, groceries are coming next. For that family, every headline about oil at $120 a barrel isn't abstract, it's Tuesday, and that very real pressure is exactly what the bear case runs on. Here's the fear chain. Oil spikes. Higher energy costs push up inflation across everything. Manufacturing, shipping, food. If inflation rises, the Fed can't cut rates like it planned. If it gets bad enough, they raise rates. Higher rates slow growth. Slowing growth plus rising inflation equals stagflation, the financial nightmare of the 1970s that took a decade to unwind. That's the bear case. I'm not going to tell you it can't happen. But comparing 2026 to 1973 is like diagnosing someone with the flu because they also have a headache. Yes, there's an overlapping symptom. The conditions underneath are completely different. In 1974, inflation was running at 10.1% and climbing toward 14.5%. Unemployment hit 9%. GDP was contracting. The US was almost entirely dependent on foreign oil. Wages had automatic cost of living adjustments baked in, meaning inflation fed directly into more inflation in a loop that took Paul Volcker years and interest rates near 20% to finally break. Today, inflation is 2.7%, unemployment is 4.2%, GDP is still positive. The US is now one of the world's largest oil producers. Productivity, which collapsed in the 70s, is surging at over 4% annually, mostly from AI adoption. The structural conditions that made the 70s a decade-long disaster simply don't exist. Economists who've modeled this put stagflation probability at 20 to 40%. Elevated, yes. Base case, no. And here's the thing about markets. They've already priced in the worst case, which means if the worst case doesn't fully materialize, and historically it rarely does, there's only one direction prices move from here. Okay, put your gut feelings to the side. When you have a gut feeling about the stock market, go to the bathroom. That's where gut feelings belong. Let's talk about data. RBC Wealth Management analyzed 20 major military conflicts since 1950. Korea, Vietnam, the Gulf War, Iraq, Russia, Ukraine. Across all of them, the average S&P 500 decline was 6%. The market bottomed in an average of 13 trading days and fully recovered in an average of 28 trading days. Let that sit for a second. Less than 6 weeks, start to finish. While you were waiting for certainty, watching the news, feeling sick about your portfolio, the recovery had already happened. The people who stayed invested captured it. The people who moved to cash captured none of it. When Iraq invaded Kuwait in 1990, oil spiked, markets fell. Sound familiar? The S&P dropped 15.9%, then gained 29% in the year following the war's end. When the Iraq War launched in 2003, the Dow actually rose 2.3% the day of the invasion. S&P gained 26.7% over the next 12 months. Even World War II saw the Dow gain 50% from 1939 to 1945. Wars feel catastrophic. Economically, they historically haven't been. The American economy is large enough to absorb almost anything that doesn't directly halt its functioning. Nothing happening right now comes close. Here's the bigger structural picture. Average bull market over the past 100 years, 4.9 years, 177% return. Average bear market, 1.5 years, 35% decline. Positive returns over rolling 10-year periods 94.1% of the time, and over rolling 20-year periods 100%, every single one in recorded history. I know that sounds like something a guy would say in an infomercial at 2 a.m. I'd be skeptical too, but this isn't a prediction. It's the complete historical ledger, every 20-year period, including the ones with world wars, depressions, oil embargoes, and financial crises in them. Zero exceptions. None. And the feared lost decade from 2000 to 2010, where the S&P went essentially nowhere. That's happened twice in a century. The probability of it recurring from today's conditions is roughly 5%. And even in that scenario, if you kept investing through both crashes and held 20 years, your total return was 350%. You still quadrupled your money, just slower than you wanted. Here's where this gets genuinely uncomfortable, because if the data is this clear, the question isn't whether this is an opportunity. The question is whether you'll actually be invested when it resolves. And for that, let's look at what this exact setup created the last time it happened, March 2009. Market is down 57%. Every headline is collapse, bankruptcy, recession. General Motors is going bankrupt. Banks are being bailed out. Smart, credible people are saying we might be in a structural economic breakdown with no clear end. Now picture someone who kept putting $500 a month into Amazon from March 2009 through the end of 2019. Not a hedge fund manager, not someone with a windfall, just a person with $500 a month and the nerve to keep going. Total invested over 10 years, $60,000. What that position is worth today, roughly $2.3 million. That's not a story about genius. That's a story about someone who didn't stop when everything around them was screaming to stop. Here are the numbers behind it. Amazon bottomed at $1.75, split adjusted in 2009. It's now $210, your 120 times return, Microsoft sat at $15. It's now $383, 25 times return, turning $10,000 into $255,000. Apple bottomed at $2.79 split adjusted, a 90 times return from there. The S&P 500 itself went from 676 to roughly 6,500, nearly 10 times in under 15 years. These weren't lottery tickets, they were the largest. Most dominant companies in the world, bought at panic-driven discounts by people who had the nerve to keep buying when the news said stop. Now look at what's sitting at a discount today. Microsoft is down 20.5% year to date, Amazon nearly 9%, Meta over 8%. Same caliber of businesses, generational dominance, massive moats, earnings that don't depend on any particular geopolitical outcome, available at prices that were simply unavailable 6 months ago because fear is doing the pricing right now, not fundamentals. So if the data is this clear, if 2009 created those returns, why doesn't everyone just do the right thing? Why did guy number one move to cash? The cleanest recent example, March 23rd, 2020, the S&P bottomed at 2,237, COVID was spreading, economies were shutting down, and the financial press was genuinely asking whether markets would ever fully recover. Millions of retail investors sold. They moved to cash and waited for certainty. By August, 5 months later, the S&P was back at all-time highs. From that March low, it has since tripled. The people who sold and waited for certainty bought back in higher, crystallized their losses, and missed the entire recovery. Not some of it, all of it. And this isn't a unique event. This is the pattern. Every single cycle, without exception. The reason it keeps repeating is that your brain is specifically clinically wired against doing the right thing here. Kahneman and Tversky established through decades of research that losing a dollar feels roughly twice as painful as gaining a dollar feels good. This isn't a character flaw, it's evolutionary wiring. The humans who survived were the ones who strongly avoided losses. That wiring is in your skull right now, watching red numbers scroll across your screen telling you to get out. Dalbar has tracked the gap between what the market returns and what the average investor actually captures for 30 years. Over 3 decades ending in 2015, the S&P 500 returned 10.35% annually. The average equity investor, 3.66%, a gap of 6.69 percentage points every single year. Compounded over 30 years, that's the difference between retiring comfortably and running out of money. And it exists almost entirely because people sell during exactly the conditions we're sitting in right now. Here's the mechanism that makes it so brutal. JP Morgan's data, $10,000 fully invested over 20 years grew to $64,844. Missed just the 10 best trading days, 10 days out of roughly 5,000, and you're left with $29,708. Missed 30 of those days, and you barely beat inflation. And the part that should genuinely alarm you, 76% of the market's best days happen during bear markets or the first 2 months of a new bull market. The days that build most of your wealth happen during exactly the fear environment we're in right now. If you're out, you don't get them. You can't go back and get them later. Here's the part most finance videos skip because it requires actually giving you something useful. So let's talk about what to do with all of this. First, I can't tell you where the market is in 6 months. Zero ability. Anyone claiming otherwise is selling something, probably a newsletter with a very aggressive subject line. This framework doesn't require predicting anything. It works whether markets go up, sideways, or down further from here. Part 1, at least 40 to 50% of your investable money belongs in a broad market S&P 500 ETF, SPY, VOO, your choice. This is the vehicle with positive returns in 100% of all 20-year periods. No financial manager has consistently beaten it over 20 years, not one. At current levels, roughly 8.7% below all-time highs, you're buying at a fear discount on something with a perfect long-term track record. Part 2, layer quality individual companies on top. Durable business models, dominant market positions, earnings that don't depend on any particular geopolitical outcome. Microsoft, Amazon, Meta, Google, all sitting at prices unavailable a few months ago. In the mid-cap space has even more dramatic discounts on companies whose fundamentals haven't changed at all. Fear did the pricing, not facts. Part 3, this is the one that determines whether parts 1 and 2 actually work, is discipline. Keep investing during the bad months, every month. And if you can manage it, invest more during the bad months, not less. The math here is actually kind of beautiful. When the market drops 30%, your monthly investment buys 43% more shares than before. A 40% drop gives you 67% more shares per dollar. You're not losing ground on those months. You're accumulating ownership of great businesses at a discount. The $500 a month Amazon investor from 2009 didn't get rich because they were brilliant. They got rich because they kept going when everyone else stopped. Kersif's analysis of investing through the 2007 to 2014 cycle found that consistent monthly investors captured a 66.6% return. The ones who doubled contributions when markets dropped more than 5% earned 83.9%. The panic sellers got whatever their savings account was paying, which during that period was essentially nothing. One more thing that consistently gets underplayed. When the rest of the world gets unstable, money doesn't scatter randomly, it goes somewhere specific. The United States, every time, over 60% of global foreign exchange reserves are held in US dollars. The Treasury market is $24 trillion, the deepest, most liquid financial market on Earth. When things go sideways globally, institutional money from every corner of the world flows into dollar-denominated assets. Not because anyone loves the dollar, but because there's nowhere else large enough to absorb it. During March 2026, the US dollar index surged 2.6%, its best month since July. During COVID, it spiked 9%. During Russia's Ukraine invasion, nearly 12%. Global chaos and US market performance are not the same thing. Historically, they can actually move in opposite directions. Goldman Sachs, whose year-end S&P target is 7,600, roughly 16% above where we are, notes that private sector balance sheets across households, corporations, and banks are genuinely healthy. No hidden leverage bomb, no subprime time bomb, no shadow banking collapse. The fear is real. The structural conditions for a multi-year collapse are largely absent. Those are very different things. Right now, somewhere between watching this video and opening your brokerage app, you're going to make a decision. That you might not frame it as a decision. It might just feel like a vague sense that you should probably wait this out, but that feeling is the decision. Here's what the 3 actual options look like. Option 1, sell, wait for things to feel safer, then get back in. This sounds like caution. It is not caution. Waiting for safer is code for buying back in at higher prices after missing the recovery days. It's why Dalbar keeps publishing that 6.69 point annual underperformance gap. Selling during extreme fear is the most expensive financial decision most people ever make, and almost nobody realizes they're making it in real time. Option 2, do nothing. Hold what you have. Don't add, don't sell. Better, you won't lock in losses, you won't miss the recovery. But you won't capture the compounding advantage of buying at discounted prices either. Holding is the floor, not the ceiling. Option 3, keep investing. Stay on your regular schedule at minimum. Your emergency fund stays your emergency fund, and you don't invest money you'll need in the next 12 months. But the money you were planning to invest anyway, you're getting it at a discount that didn't exist 6 months ago. That discount is the opportunity. And if it falls further before recovering completely possible, your monthly contributions keep lowering your average cost. When the recovery comes, and based on 100 years of data it comes, you recover faster with more upside than if you'd frozen or sold. The only scenario where this logic breaks is if the US economy permanently collapses and the S&P goes to zero. And if that happens, your stock portfolio is genuinely the least of your problems. Let me bring this back to where we started. The 2 guys in March 2009, same job, same salary, same $5,000. One moved to cash because it felt rational, and it genuinely did feel rational. Every headline supported protecting yourself. He wasn't stupid, he was human. The other kept investing because he understood something specific. The feeling of certainty he was waiting for, that "it's safe now" signal, was always going to arrive after the recovery had already started. By the time things felt safe enough to buy, the best prices would be gone. That's exactly what happened. The bottom was March 9th, 2009. By June, the S&P had already recovered 40% from the low. Investors who waited for the news cycle to confirm recovery got back in at $450, not $676. They still participated, just in less of it. And the difference between all of a recovery and half of one, compounded over a decade, is the difference between $210,000 and $18,000. The current diplomatic signals, Trump signaling openness to ending operations, the Iranian president issuing conditional peace statements, suggest we may already be at or near the fear peak, not the beginning of it. Wars average 13 trading days to bottom. We're already past that mark, which doesn't guarantee this is the bottom. It means the window is almost certainly closer to closing than to opening. Generational buying windows are rare precisely because they require conditions most rational people find intolerable. CNN, fear and greed in the bottom 3% of all historical readings, oil up 63% in a month, your portfolio going red every week. These conditions create the discounts, and they don't last. The moment enough people believe the recovery is coming, the prices at which recovery was cheap disappear. The 2009 window lasted about 3 months. The COVID window lasted weeks. This one is open right now. Guy number one, the one who moved to cash in March 2009, didn't do that because he was careless. He did it because being careful felt exactly like the right call when everything was falling apart. The problem wasn't his intention. The problem was that his nervous system was making a financial decision that his logic should have been making instead. The gap between him and guy number two wasn't intelligence. It wasn't income. It wasn't some secret information. It was the ability to look at what the data said and act on it. Even when every headline, every news segment, every conversation with friends was pointing the other direction. That gap between knowing and doing is where generational wealth either gets built or gets missed. It has always been that gap. Most people right now are just reacting to headlines. Watching the number on their brokerage app go red and feeling physically sick, they'll make a fear-based decision and move on, and 10 years from now, they'll wonder how other people got so far ahead. You don't have to be that person. You just have to understand the math clearly enough to act on it when your gut is screaming otherwise. That's the whole thing. The window is open. What you do with it is yours. If this changed how you're thinking about the next few months, drop a comment. I read all of them. Subscribe if you haven't. I'll see you in the next one.